Watch what they do, not what they say, right? Well, in this episode, we're going to talk a little bit about what they're saying, a little bit about what they're doing, and the big boys and girls are making some big moves. Don't be fooled. They're not just going to sit back and watch this fourth industrial revolution roll out without getting a huge stake in what is taking place. So we're going to be talking about a JP Morgan Hall of Famer investor who's predicting a 20% crash. We're going to be looking at the secret Goldman Sachs patent for DLT technology. And then we're going to be talking about the BlackRock insider exposing how we're about to open up $17.7 trillion cryptocurrency earthquake coming from Wall Street with the ETFs that are getting approved. And of course, we're going to ask the question, when XRP ETF? So if you're excited to get right on into this episode with me, make sure we're subscribed, hit that notification bell, and that we smash that thumbs up on all of our content. Let's get right on into it, folks. Taking a quick look at this market right now, starting it off with the JP Morgan Marko Kolanovic bracing for a 20% market plunge, delivers recession warning on CNBC. So finally, someone coming in here, JP Morgan, apparently this guy's an institutional investor Hall of Famer, says that high interest rates are creating a breaking point for stocks, and choosing cash at a 5.5% return in money market and short-term treasuries is a key protection strategy right now. He is bracing for a 20% sell-off to hit the S&P 500. Quote, "I'm not sure how we're going to avoid it," and he's talking about the recession, "if we stay at this level of interest rates," the firm's chief market strategist and global research co-head told CNBC's Fast Money on Thursday. So finally, one of these guys is, coming out and admitting what we've been saying here for a while, that we're already in a recession. Okay. And that the higher interest rates for longer is going to kill us, right? And we need to be prepared for this. And oh, by the way, the banking crisis is not over. The Metro Bank shares plunged 27% today, down 62% in the last month as it tries to urgently raise 600 million pounds. Banking crisis 2.0 is coming. No, this is the banking crisis that we started in March and is still going on. We're not over. We haven't made it to banking crisis 2.0. We've had additional smaller regional banks in the United States fail. We got this one out of the UK. Or is that Australia? That's Australia. Metro Bank. And this is the situation at hand. This banking crisis is nowhere near over. What's this going to do to Bitcoin? Well, short term, we're going to get our TA from Tara, Precision Trade 3 on Twitter. She says, "Hello, everyone. Bitcoin update. So far, so good. We got a perfect touch at the 618 fib for wave 2C, winky face. Since then, it's dropped fairly strong. I'm now tracking the subwave 3C, currently targeting about 25.8. This wave will be 5 subwaves and is very likely to extend. I'll keep you updated as the subwaves form." And we're talking about Bitcoin, of course. So here's your full chart here from Tara, back down to the 618 fib. And that's going to be pushing us sub 26K. Watching this one closely. A little bit of a bull trap rally underway. Stuart Alderati chiming in on the SEC's brief in the Coinbase case. He says, "There is so much wrong with the SEC's brief in the Coinbase case, I don't know where to begin. Let's start with the SEC claiming, without citation or support, that digital assets have no innate or inherent value, while collectible baseball cards do. It's an absolute joke. And who's the SEC going after next? Well, they're proceeding to and continuing to go after Elon Musk. SEC sues Elon in Twitter stock purchase case. Another witch hunt has started. The SEC, which has been investigating Elon's 2022 purchase of Twitter shares, is now suing him to force him to testify and comply with their subpoena. This is yet another attack on Elon by the Alphabet organizations. Here are a few of the others. Okay, so of course we know Tesla. The Department of Justice and the SEC claim that Musk used millions of dollars from Tesla to secretly build himself a spacious glass structure labeled as House for CEO Elon Musk. Not making this up. Elon replied, "This is one of the funniest things I've ever heard. Where is this house? Metaphors don't count." And then in regards to Twitter, X got in trouble with the Biden administration after refusing to hand over Trump's personal Twitter data and information to prosecutors. Okay. We also know about SpaceX. The Department of Justice sued SpaceX for discriminating against refugees in the company's hiring process. So there's clear evidence of multiple three-letter agencies going after Elon Musk. And once again, what game do they play? They go after the new guy on the block while they protect the incumbents. Now, what we see here in this next article is from T's Crypto Spot. He says, well, Goldman. And we're taking a look here at Goldman Sachs. And just like as we've exposed with the SEC versus Ripple case, why did they have to go after Ripple and XRP? They were the biggest threat to the incumbents. Why are they going after Elon? Well, he's decided to be completely activated now, right? And providing a free speech platform is now a controversial thing in the United States of America, of course. And then there's other allegations, there's other stories. Is Elon Musk an angel? Absolutely not. Okay. And so, but once again, is he running a legitimate business? And did he commit any sort of fraud, any bad? I don't believe so. If they have it, let them get it. Let all truth be revealed. You know my stance on this. But when I look at the three-letter agencies, all of them, and the SEC's overreach and over abuse, of Ripple, of the cryptocurrency space, the lack of faithful allegiance to the law as cited in the SEC versus Ripple case, it's very clear what they're doing and how much money's on the line. They do all of this while they let their buddies get in on the action. And that's what we're looking at here with the Ledger Insights article on the Goldman Sachs patent aiming to bring fractional banking to crypto in DLT. In June, Goldman Sachs filed a patent application that aims to support fractional banking in the cryptocurrency world and on distributed ledger technology more generally. In the patent preamble, Goldman notes there is a one-to-one relationship between a token and its ownership in the cryptocurrency world. This technical limitation of existing approaches make it impractical to use many powerful financial technologies that involve leverage with such cryptocurrencies. They want to allow you to leverage your digital assets. Sounds good to me. Crypto's fully backed lending. The patent talks about pools, but not the sort of liquidity pools that the crypto world is familiar with, which operate relatively conservatively. As context, with crypto lending protocols such as Compound and Aave, when multiple users deposit their dollar stablecoins, the amount the protocol lends cannot exceed the total deposited for that token. This is the critical difference compared to what Goldman proposes. Now, we just covered this actually in yesterday's update about how Ethereum only has 33 billion staked for $417 billion worth of value. This patent right here is talking about that exact scenario. In the case of Ethereum, you have about 8% of collateral backing the overall value of the whole program ecosystem known as Ethereum. 33 billion staked for 417 billion in value versus of NFTs, ERC20 tokens, and Ethereum on the Ethereum ledger. That's the current numbers. So this is what Goldman Sachs patent is getting ready for, is to allow for even more leverage. Oh, gee, let's have some fun. Fractional banking crypto style. Goldman's patent talks about pools that contain tokens where it's possible for the claims on the tokens to be greater than the amount in the pool, i.e. the example that I just shared with you. 33 billion staked, 417 billion of value. Okay? If you think about a run on a bank, Goldman is providing a smart contract-based solution for such a run. So they will code in smart contract to protect against said bank run. For example, the smart contract would allow claims or deposit withdrawals until the reserves left in the pool hit a fractional limit. At that point, you're faced with more claims than funds in the pool. How the remaining depositors are paid back is based on rules. It might be they all received a fixed percentage of what they're owed, and there may be a separate deposit insurance pool that pays out up to a limit. So essentially, if you get margin called, if the value of the collateral drops below your limit, you're going to get margin called. It's the same thing, right? But they're bringing fractional banking into digital assets, and they're getting very serious about this. And once again, this is Goldman Sachs. I'm about to show you guys BlackRock and what they're saying over at BlackRock, talking about the cryptocurrency earthquake that is coming. This one was shared in Forbes, says BlackRock insider primes crypto for a huge 17.7 trillion Wall Street earthquake that could be about to hit the price of Bitcoin, Ethereum, and XRP. Now, they're talking about the ETFs that are getting approved or considered. And they say Bitcoin and other major cryptocurrencies, including Ethereum and Ripple's XRP. Now, by the way, why are we still calling it Ripple's XRP? It is Ripple and the people's XRP, right? Ripple doesn't own all of the XRP. They don't own the ledger or consensus. This is a decentralized network. And they do have the largest amount of XRP tokens for sure, but this is not Ripple's XRP. So Forbes, once again, we're talking, this article is from, today, October 5th, 2023, and they're still getting this incorrect. Here we are in 2023, and we're still acting as if, Ripple has complete control of XRP. They don't want you to understand XRP. They don't want the masses to get in on XRP. They want you to buy into their Ponzi, Bitcoin, and Ethereum. Completely controlled since the beginning. And they say that the cryptocurrencies have been rocked by the Federal Reserve this year, creating what could become a Bitcoin price nightmare. As we alluded to at the beginning, right? Bitcoin could see a little bit more of a pullback here. The Bitcoin price up almost 70% so far this year, helped by BlackRock, the world's largest fund manager, that looks after around 10 trillion worth of assets, driving a surge of Wall Street Bitcoin and crypto interest. As the patents allude to, which, by the way, if you look at any one of these banks, Goldman Sachs, Bank of America, they all have dozens of patents for DLT cryptocurrency technology. They've all gone all in on this. Now, a former BlackRock managing director, has predicted it's only a matter of months until the SEC approves a long-awaited Bitcoin spot exchange-traded fund, giving funds that manage 17.7 trillion worth of assets the green light. That's massive. That's absolutely massive. And he says the SEC will probably approve all Bitcoin ETF applications at the same time. I don't think that they want to give anybody first mover advantage. Now, some of them they may, not approve. They may deny ultimately some of these. But I think that his speculation is right, that they're not going to try to give anyone first mover advantage. They definitely are allowing their buddies to get first mover advantage by prolonging, giving everyone time, delaying, get on board. Okay, now we'll approve everyone. Now that BlackRock and Franklin Templeton and everybody else is getting in on it, now we'll approve the ETFs. Go ahead and play. That's what we're waiting for. And this is former BlackRock managing director Stephen Schoenfield said this week at the London conference. It was reported by Decrypt. And he gives the SEC 3 to 6 months until it approves a Bitcoin spot ETF. And last month, we saw 1.5 trillion manager Franklin Templeton filed with the SEC for a Bitcoin spot ETF, joining a flurry of applications that was kicked off by the world's largest asset manager, BlackRock, in June, and includes Wall Street giants Fidelity, Invesco Galaxy, and Wisdom Tree. So there you go. Wall Street coming in a major way. And we're talking about trillions upon tens of trillions coming into this space. Who's ready? As I titled this episode, XRP is ready with full legal clarity in the United States as not being a security. So if you want to add it to your balance sheet, you can pick it up. If you want to use it for its utility, the utility is just beginning to ramp up, and you also can put it on your balance sheet as a store of value and as an asset that's about to appreciate in value. And that's one way to adjust your balance sheet for banks like Bank of America that have 100 billion of unrealized losses on their bonds. They have a balance sheet program. So you add a little bit of XRP to your balance sheet. The central banks of the world stacking more gold than they have in 50 years. You add a little bit of gold to the balance sheet. Right. And then we start to write these assets up as we see price appreciation. And that's what's coming. And my main question here is who's going to get the trillions upon tens of trillions of dollars coming into this space? Quick side note, and I want to make sure you guys understand this. So I break this down very simply. You have market cap, you have liquidity value. With this Wall Street insider, BlackRock insider sharing with us that we have 17.7 trillion of a Wall Street earthquake coming into crypto, that is market cap coming in. So instead of that market cap being in stocks, and that's how we traditionally value stocks, right, with our market cap calculation. But as I've laid out in the past, what we're talking about with XRP, on-demand liquidity, and the specific utility of liquidity, and a great example of is Swift's liquidity value of $6 trillion on a daily basis. That is different from the market cap that is coming into this space as a store of value. So we have a $17.7 trillion earthquake that is coming into this space, and that's going to be a market cap addition, right? And that's pretty good. That takes us somewhere fun. Absolutely. We're going to have a good time with that, because right now the overall cryptocurrency market cap is only at 1 trillion, and we reached 3 trillion last bull run. My prediction is that we pass 10 trillion this next bull run. And we're just getting started, by the way, folks. And we're talking about 17.7 trillion coming in as market cap. What I get so excited for is when we start to settle up and we're talking about the liquidity value. It's a different calculation, a different equation than the market cap calculation. You have to understand how much XRP you need at what price to provide said liquidity value. And so what I'm excited to see is, does Swift's 6 trillion daily volume move on to DLT technology? Does ACI Worldwide's $14 trillion daily volume move on to DLT technology? And, is it going to move on to a public mainnet ledger? That might be far-fetched, but when you see the interoperability between the private and the public layers that all of these, institutions are needing, right? And you look at companies like Ripple that are facilitating that with the private ledger for central banks, public main chain stablecoins, US dollar-backed stablecoins like Palau did, and we have a combination of both private ledgers, public ledgers, and the benefit of going on public is you stand out, you have nothing to hide, complete transparency, and then you get to partake in having XRP as that native asset that you may have added to your balance sheet as well. As we see significant price appreciation, I think that we're talking about tens of trillions coming into this space into market cap calculation. But then as we start to get 5-10% of Swift rolling over, we now know that, basically Swift is going to have 87% of their network is going to be on ISO 222 messaging standard. Does that all go to XRP? No. Does it go to XRP, XLM, XDC, and a little bit on each chain? That's the world that we see. That's what I see coming, is that this is going to get divvied up amongst us, but we're talking about trillions coming in as a store of value, and we're talking about settling trillions on a daily basis in the form of liquidity. Sounds like a good time to me. And I want you guys to remember during this bear market, during this recession, that all the big boys and girls are lining up their patents. They're getting their ETFs approved. They're getting ready to pour trillions of dollars in. And it's up to us to be able to ride out this storm, ride out this chaos, recession, bear market, remain positive, and having that strength and ability, conviction to continue adding to our little bags. We might not have 10 trillion assets under management like BlackRock, but we can work with the bag that we got. We can work on our businesses, work on improving our skills so that we can make more money, so that we can stack more suppressed assets. This transition into a new financial system is here without a doubt. It is undeniable. And the interest that we see from the biggest institutions in the Wall Street boys and girls is undeniable as well. So the train has already left the station, according to Rosie Rios. I'm glad to be aboard, and I'm trying to help as many people as possible get on board with us. So please do me a favor by smashing the thumbs up, sharing it out far and wide, and I will see you guys in the next one. God bless you all.